welcome to everybody to this NOREXECO Price Risk Management webinar. My name is Anita Chong. I'm the Market Director of Pulp for both Europe and the China future contracts. I have been working with NOREXECO for 5 years now, and I've been working with commodity futures for about 20 years. I will be the co-host of this webinar together with today's moderator and our CEO, Stein Ole Larsen. And with that, I will hand it over to you, Stein Ole.
Thank you very much, Anita. Anita will be together with me during the seminar. And thank you for the introduction. My name is Stein Ole Larsen. I am CEO of NOREXECO and also one of the founders. So I've been with the company from the beginning. This is the 5th annual risk management seminar that we host at NOREXECO. And of course, all the previous ones has been live in Oslo. This time it is a webinar. We are used to the webinar format, every one of us, so we'll try to run it as smooth as we can. NOREXECO is, as you probably know, a regulated marketplace. We are focusing on pulp and paper products. And if you look at the session that we're having today, it's in a series of 5 webinars or seminars that we have held previously. In general speaking, you can say that the objective of these seminars, which are quite specialized, the objective is to increase the competence on risk management. And we do this, of course, to assist making NOREXECO a good marketplace for all market participants. For this particular webinar today, we are having 3 objectives. 1, we hope that we will increase the understanding of the use of futures in the pulp and paper markets. 2, we will try to learn with experience from other markets. And 3, we will learn how to measure risk and how to actually handle it. So those are the objectives of the day. You know, risk management is a very wide area. So we cannot reach all parts of this topic within one seminar, but we will do the best we can. And in order to help us doing this, today we have with us John Banaszkiewicz, or John B. He is CEO of Freight Investor Services, or FIS as it's called. And John B, he has a great experience when it comes to commodities. FIS has been with commodities and been building it from low liquidity to high liquidity. So he has a lot of experience from other commodities, which will be relevant for pulp and paper as well. Then we have Sjur Westgaard. He is a professor at the Norwegian University of Science and Technology. He has experience from commodities, both from the financial industry, from consulting, and of course, from tutoring. We also have with us Sharon Levrez. She is a price risk assessment manager at Fastmarkets RISI. She has deep knowledge of the pulp and paper industry, and she also has commodity experience as a director of product development at Platts. So after each session today, there will be an opening for questions. Anita has already touched upon it, but please don't hesitate posting your questions on the Q&A part of this. So then I think we should get started. So Sharon, I'll hand it over to you, and I wish you good luck with your presentation.
Thank you very much, Stein, for that introduction. As Stein said, do we have the slides? My name is Sharon Levrez, and I'm Price Assessment Manager at Fastmarkets Forest Products. That includes Fastmarkets RISI, Fastmarkets Forex, and Random Lengths. And I'm going to be speaking today about volatility in pulp and paper markets and the role of futures. Can we have the next slide, please? We're going to take a look at volatility in various commodity markets, including pulp and OCC. We're going to see that volatility in pulp and OCC markets is increasing over time. And that means that the risk related to sharp price moves is also increasing. And finally, we'll take a look at pulp futures and their effect on physical markets. Next slide, please. This slide shows the 5-year volatility of selected commodities, Brent crude, copper, cotton, pulp, and OCC. You will see that OCC is a clear leader in terms of volatility. Quarterly volatility stands at 32%. But pulp too is in line with these more mature liquid commodities. Annual volatility for both pulp and OCC stands at 20%, which is comparable with Brent at 18% and copper at 21%. Of course, the volatility is not a constant. The last 12 months have been particularly volatile for most of these commodities. And who can forget crude oil dipping below $0 per barrel last year. Pulp was less volatile last year, but it's more than made up for it in 2021. And we'll see that a bit later on in the presentation. But first, let's take a look at OCC. Next slide, please. This chart shows PIC's OCC 1.4 index mapped against Fastmarkets 3C's price assessments for the German and UK market. You'll see quite some volatility there, and particularly in the last 12 months, the volatility has been quite spectacular. We'll come on to the reasons for that a little bit later on. But to look at some of the statistics, the PIC's OCC 1.04 index was up 338% in February, from February 2020, which was an all-time low. And there have been quite some fluctuations in the last 12 months. This kind of volatility is not limited to Europe. We've seen similar moves in other regions. In the US, the Fastmarkets 3C's US average price for OCC in March was up 264% on last year, but down 23% on the highs of last May. And in the recovered paper market in Asia, we've seen all-time high prices in the last few weeks. Next slide, please. To look at some of the drivers in the OCC market, we show a major decline in prices from 2017 when China announced limits on quality restrictions on imports of recovered paper, culminating in the complete ban of imports of recovered paper from the start of this year. But there was a strong recovery in 2020 and 2021, and that was primarily related to the COVID-19 pandemic. Lockdowns introduced in countries around the world led to cuts in collection rates and shortages of supply. At the same time, there was a boom in e-commerce, again related to the pandemic, as people bought more and more of their goods online rather than in the shops. And this had an impact on demand for packaging, and as a result, demand for OCC with which to make that packaging. We've also seen in the last 12 months shipping restrictions, a shortage of available containers and soaring freight rates, which have further hampered the supply situation and have led to delays in customers getting hold of OCC. And we've seen strong demand in Asia, India in particular, again related to China's needs, having stopped imports of recovered paper themselves. We've seen other Asian countries buying up OCC either to produce recycled pulp or to produce packaging to then feed the China market. Next slide, please. So right now we are in quite an uncertain period. The pandemic is by no means over, and it's unclear whether people's buying and recycling patterns will return to pre-COVID levels when it's over. In addition to that, we have more states considering restrictions on quality and bans on imports of recovered paper, particularly in Asia. And depending on your appetite for risk, it would seem prudent in this situation to hedge some of that price exposure, either using OTC swaps or using futures such as those offered by NOREXECO. Next slide, please. Let's take a look now at pulp. And this slide shows the trends for the benchmark NBSK grade of pulp over the last 20 years in various regions around the world. You will see that volatility is growing. The divergence in price between regions also appears to be growing, but the trend generally remains the same. The prices track each other. And from our observations, one of the leading drivers in price of pulp is the China market, and that's the purple line at the bottom. And you will see from November 2020, there's been a sharp increase in prices there, which has had a knock-on effect around the globe. Again, we'll come on to the reasons for that in the next slide, but to look at some of the statistics. Net prices in China are currently at all-time highs. They're up 70% from this time last year and 40% since the start of the year. In other regions where we've seen a similar increase, the US saw the biggest monthly increase in decades in February, with prices up $115 per ton or more, and more increases slated for March and April. In Europe, we saw price increases pass through quite easily in January and February, almost without negotiation, such a strong market. And we've seen hardwood, softwood spreads balloon out to over $250 a ton, which is really unprecedented. Next slide, please. So as I mentioned earlier, the pulp market in 2020 was rather lackluster. But towards the end of the year, it showed signs of being ready for a recovery. Demand picked up from the pandemic lows, particularly in China. China was one of the first and hardest hit by the pandemic, but has been one of the first to recover. And while the graphic paper industry there still is struggling a bit, tissue and cartonboard markets are rather robust and are supporting demand for pulp. We've also seen a number of supply side restrictions in the last year, disruptions and extended downtimes, as well as similar to OCC, a lack of available containers and delays in getting the pulp to the end user. We've seen a strong Chinese currency against the dollar, which has made price increases more palatable for Chinese buyers. And on the inventory side, on the whole, the situation is tighter than in 2020. Producer stocks are balanced to below balanced. Some large end users have sufficient stocks, but some smaller companies have not so good stock levels and have been forced to chase tonnage in a rising market. And this has led to additional price pressure. And last but not least, there's been the impact of futures prices, particularly traded on the Shanghai Futures Exchange, which it seems has exacerbated the increase in prices. It's probably fair to say that without the impact of the SHFE, prices wouldn't have risen so fast or so high. Next slide, please. This slide shows Fastmarkets RISI's NBSK SIF China price against the Shanghai Futures Exchange settlement price minus VAT and logistics, just so we're comparing apples to apples. We've seen a convergence in prices here, roughly since June 2019, which incidentally was the first month that SHFE listed for its pulp contracts. The convergence has only strengthened since then as the SHFE becomes more established and volumes increase. We saw 350 million tons traded on the Shanghai Futures Exchange in pulp contracts in 2019. 400 million in 2019, 350 million in 2020. And already this year, they've beaten last year's record with 360 million tons traded as of last Friday. So why is it that the China pulp market is being so affected by the futures? Perhaps the next slide, please. You can look at some of the relationships between them. You essentially have three markets in China: the futures market, the domestic resale market, which often takes its pricing cues from the futures market, and the offshore carbon market. And when futures prices rise sharply, taking them significantly above the physical market, it creates an arbitrage. Traders can come in and buy pulp on the physical market, sell it on the exchange, and lock in a profit. At this point, what's important to them is not necessarily the outright price of the pulp, the physical pulp, but the profit that they can take by selling it on the SHFE. So what we saw in the last few months is that traders were willing to pay more for their pulp and that end users active in the physical market have had to compete with that to get the tonnage. And this has been true both in the domestic resale market and in the offshore cargo market, because some of these big Chinese traders are active in both. This has also had an effect on prices in other regions, as producers may allocate additional volumes to China away from other regions, or even sell forward pulp for delivery in future months. So when normally they would be trading shipments for the current month or next month out, we saw in February even producers were selling forward May shipments of pulp. The converse can be true if there's a bearish futures market. It can also keep a cap on physical prices or create downwards pressure. And we saw a little bit of that in 2020, where a few times producers would try to introduce a price hike, but the depressed futures market prevented that from going through. Next slide, please. So we're kind of in uncharted territory here with prices at all-time highs and people asking whether the increases we've seen in the last few months have really been justified. We've heard the question, is this a bubble? And if so, when it will burst? Some people thought prices would fall after Chinese New Year. That didn't happen. In fact, prices went up further because the fundamentals were strong enough to sustain that. So again, it would seem, depending on your appetite for risk, it might be prudent to hedge some of your pricing exposure in this situation, either in the OTC market or using futures. Next slide, please. And on this point, we know a lot of international companies have trouble accessing futures such as the SHIFI, and that is a domestic resale market. But NOREXECO is planning 2 new instruments which might be of interest to the wider international market in the next few months. Be 2 cash settle contracts, one softwood and one hardwood. A softwood contract based on Fastmarkets Reezy's NBSK CIF China price, and a hardwood contract based on PIC's BHKP China price. These are prices that are already used in some physical and financial contracts. They're rooted in a robust pricing methodology and based on transactions concluded in the physical market itself. So Fastmarkets doesn't talk to investors and financial players to produce these assessments and indices. They talk to the physical market players, the people who are active buying and selling pulp on a daily or weekly basis. We hope these new futures should provide physical market players with a more appropriate tool with which to manage their price exposure going forward. They also allow them to cash in on some of these arbitrage opportunities between China's domestic resale market and the offshore cargo market, between the China market and the European market, as NOREXECO also has a European contracts, and also the spread between hardwood and softwood pulp. Thank you. Any questions?
Thank you very much, Sharon, for your good presentation. I'm sure there are some questions. We will look into them. Just give me a second. I can start out with one here. Is it your impression that there is a correlation between pulp and paper prices and the general commodity world indices?
I think we have seen a bit of that in 2021. Certainly across the board, commodity prices have been increasing, and pulp prices included, at least on the Shanghai Futures Exchange. But you know, if you look over a long period of time, we'd have to see.
Yeah.
It wouldn't always be the case.
Another question regarding pulp. Market fundamentals do not appear as strong as the recent price quotations indicate. Please elaborate further.
I think the fundamentals are strong, but what we've seen is such a sharp, fast increase in pulp prices. I mean, really outstripping the increase we saw in 2017. So this is a comment that's coming from the market itself. This is not my judgment. This is the market saying, is this really justified given the fundamentals? There's been kind of incredulity. Perhaps it's gone too far, too fast. It remains to be seen, see what the coming months bring.
Yeah, but I think it's, as you mentioned during your presentation as well, we started the year with the strongest rally ever, and it was driven by the future market, and there were big discussion in the markets. Is this the speculators? And we saw the physical market was following it, because if there is an arbitrage, the trader will buy the physical and sell the future against it. And actually, as you are pointing out during your presentation, now actually those are converging, and the arbitrage is taking out. So instead of the future market falling back, you actually see that the physical market is catching up. So I think that indicate that it is demand there. Because I think the last couple of weeks, the SHIFI has been flattening out a bit. Yeah.
It's sort of been range bound in the 7,100, 7,200 renminbi per ton area. And the physical market has been catching up with it. And the comment now in the market is that, that arbitrage seems to have disappeared. That the traders buying to sell in the SHIFI shouldn't be there anymore, but the physical market prices are still there. So there has to be, to some extent, a justification in the physical market.
Yeah, I agree. And there's another question here which goes to is for when you have the graph, you say you deduct VAT and logistic. What is the logistic cost you deduct?
But
the number.
Based on our feedback from the market, we deduct 120 renminbi per ton.
Yeah, okay.
For logistics. Now, sometimes people talk about 150, and we hear that's more sort of in the domestic resale market where pulp might be stored for longer and shipped further.
Thank you very much, Sharon. You will stay with us if there are questions at the end. Then we will move on to the next speaker, which is John B. John is quite new to the pulp market, and we are very excited that he is involving his company with the market. So please go ahead, John. It's yours.
Good afternoon, everyone. Good evening to our friends in China. And good morning to South America. As I said, my name is John Banaszkiewicz, as it's much easier to say John B. And my presentation today is called Pulp, Fact or Fiction. If you Google Pulp, on the website, the first thing what comes up is the band. The second thing which comes up is the film. And then way down is Pulp Futures. So I'm hoping that all of us here on this call will make Pulp Futures a much bigger part of the Google hit list. So here we go. So next slide. So my presentation today, so I've got your attention there. My presentation today is to just briefly explain who FIS is, and the next will be what makes a futures contract successful, and obviously some of our experiences in other markets. And also I'll try and map out a little bit about what the future holds and how this market should develop. Next. Okay, so in terms of who Freight Investor Services are, we're a global market leader in commodity derivatives. We're a broker. We're not a principal, a trader, or a bank. And we have been named the last 11 years as the top broker overall for dry bulk commodity derivatives. Our main markets we cover are iron ore, freight, and coking coal. We also are very keen on developing new products, and we've invented and innovated a lot of new products for a lot of customers to use globally. And we're obviously registered with all the major exchanges globally, including NOREXECO. Next. So these are the products we do at FIS. So we do dry freight, iron ore, oil, steel, base metals, cobalt, lithium, wet freight tankers, coking coal containers, and fertilizers. And obviously we've got pulp as well. And then obviously our offices, we are UK, US, Dubai, India, Singapore, Shanghai. So we have 24-hour coverage. So it's interesting. One of your last questions was about does pulp futures, is that the same as all the other commodities? Well, we talk about super cycles in commodities, and obviously we've seen a big boom in commodities. So I've just looked as we were on this call where copper was 3 months ago. It was $6,000 and it went up to $9,400. Crude oil was obviously now at $65. So pulp has, like other commodities, jumped in price. You know, it's not just a sort of individual product. Next one. So one of the key things we like to do is we like to keep our customers abreast and aware of where markets are trading, what the last price is, what the forward curves is. So we've basically created an app for all these commodities, so you can look at it at the click of a button, you know, wherever you are, you know, 24/7. And we hope to put the pulp futures prices on this, so you'll be able to track this wherever you are traveling, at home or in the office. Next one. So let's talk a bit about some of the products we do, and we look at the size of these markets relative to the physical market. So the first one is the dry bulk, which is the Cape, Panamax and Supramax vessel. The physical market is about 3.5 billion tons, mainly iron ore, coal, grains. The futures market is up 105% this year, 6.1 billion tons. So we're trading at close to 2 times. Iron ore, 62% delivering to China is 1.6 billion tons. The futures market is 18.5. Aluminium production 65. Futures market is 18 times. And obviously, as Sharon mentioned, you've got this great Chinese contract, which is traded apparently more this year than last year. It's trading at 5 times. So what I'm trying to say is, you know, these markets are well accepted. You know, there's lots of people trading them. People use these indexes for various other things like index linked. And it's something you can't really ignore. Next one. So when we look at how to grow a market or how to develop a market, we look at 3 things really. So we call it the 3 V's. Next. The first one is volume. The second is volatility. And the third is value. So I'm just going to go through each one very quickly. Volume. Next one. So as you said, you know, I'm relatively new to this market, but we've done our research, and I can't believe how big your market is. So I just took some sort of key points and key facts. So global paper production is about 420 million tons, with about 110 million tons produced in China. Obviously, they're the main products which the paper is used for: the tissue, the graphic paper, and the cardboard and others. Recycled paper, the OCC and stuff, is 230 million tons, and it's predicted to rise to 270 million tons by 2028. So when you look at specifically the pulp production, 77 million tons of pulp, hardwood and softwood, and a seaborne trade of 52 million tons, of which nearly half is imported by China. So I calculated the notional value of the pulp market is around $69 billion US. And another interesting point of this is that 50 to 70% of the pulp price is related to the end price of some of these products which you produce, and some even higher than that. That's an important point, because we're trying to get more end users to look at hedging with these instruments. To give you an example, we have car manufacturers in Germany who buy iron ore derivatives to protect themselves against rising steel prices. So we have Volkswagen and Mercedes-Benz trading. So why can't these companies, which are like Johnson & Johnson, use these products if they're such an important part of the end price? Next. So I just looked also, so volume ticks a big box for me. You've got a huge market there, big volumes, big potential, and you've got some big names in your market. You know, I just mentioned a few of them there. You've got Araco, you've got Paper Excellence, Suzano, Coke, Johnson & Johnson, OG Paper. So you've got some big hitters who are very sophisticated, stock listed companies who actually trade and produce pulp. So that also ticks a big box for me. Next. So obviously Sharon talked about this. So we're talking about volatility and pulp prices. So this is the prices for the index for Europe. And as you can see, the prices in the last 12 months for the softwood was a low of $819 and the high of $1,000. So it's 20.4% increase. That's about for somebody producing 1,000 tons of pulp for a pulp mill, it's about $200,000. So obviously, if you're a producer, you're laughing. But if you're a buyer and you've bought these prices, you're having to pay 20–30% more than what you would have done if you didn't hedge. Next. And obviously, we talked a bit about China. China obviously has even seen a bigger increase, 41% increase in price. And as you can see, once prices go up and volatility go up, volumes go up. The great thing, we talk about China because it is an important part, but it's not the be all and end all, because obviously in freight, for example, China isn't a big factor in our futures market. So it's not just China, it's everybody really. What I'm trying to say is, but the benefit of China is if you have a futures market in China, it will really help develop the market offshore because there's just huge volumes with retail and big companies trading these things. Next. So obviously that's the China index. So obviously it's mirrored the Shanghai pulp contract. It's around 44%, and they're obviously going to get launched very soon with Fastmarkets. Next. Interestingly, I thought, well, we have two companies here. One is the Canadian company based in Vancouver, Canfor Pulp Products. And I've just looked at the correlation between stock prices and pulp prices. So when I talked a bit earlier about end users, here's a company which is a very good correlation with pulp prices. So if I'm a stock analyst or I'm somebody trading stock, I want to know, what the impact pulp prices has on the stock price. So that's another opportunity for people to come into the market, which might have a different view than a producer or a consumer. The second one is the Chilean empresas. Is an 80% correlation. These are really good correlations, really, for companies who are looking at these instruments. Yeah. Next one. So what are cleared derivatives? So obviously in the pulp market, we've had NOREXECO, we've got Shanghai, we have an OTC market, which is a bilateral trade between counterparties. But obviously the products for pulp are traded on the exchanges at NOREXECO and Shanghai. They're obviously standardized, a margin required. This is for new people who haven't started to trade. The good thing about these products is they're not physically delivered, they're cash settled, so you don't expect 10,000 tons of pulp on your doorstep, and all participants have to go through their sort of vetting to comply with the exchange rules and corresponding regulation. Next. So the third point in the 3 V's is value. Does you guys listen to this? Do you really want this market to happen? It already is happening in China, but how can we have it happen outside of China? So we're going to go through this value. Next. So first of all, pulp paper futures and indexes have been around for over 20 years. So that's a tick box for me because you have historical data. So next. The majority of pulp business is fixed on a spot basis. There is a lack of long-term fixed contracts. And from what I understand, there's been a number of defaults when prices change. People try and renegotiate or change the price. And obviously, that's not acceptable in an industry, which is what drives markets to these indexes and futures. To give you an example, in iron ore in 2008, the iron ore price to China was $185. And in the summer, it crashed after the financial crisis to $46. A lot of buyers, particularly Chinese, defaulted. And that forced the market into using derivatives. So if you talk to Rio Tinto or BHP or FMG, they just use index-linked contracts now and trade spot. They don't really do these forward contracts, or they do it off an index. So it could happen in your market. Third, next one. So obviously, Sharon mentioned about Fastmarkets, very reliable company. It obviously has accurate data, and there's obviously clients are trading some of these products on an index-linked or basis, including some of the Chinese indexes on physical. That's another big tick, because if you do an index-linked, it's a floating price, and then you have to hedge it usually with futures. Next. And as I said earlier, the other big swing is the high percentage of pulp versus the end product. Next. You've already got 2 exchanges. You've already got a cleared contract. So that's half the battle, you know, because obviously we're doing some products, for example, container futures. We haven't got it cleared yet, and it's stopping us from trading. But you've already now got 2 futures markets willing to trade these products. Next. And obviously, the opportunities are there to hedge and arbitrage for the traders between the futures and the spot markets. So obviously, the differences in paper may be higher than the physical, so you can take advantage of that, like we do in all the markets we trade. Okay, next. And obviously, there's opportunities between the RMB and the correlation with the Norwegian Pulp exchange. So there's opportunities between the domestic Chinese RMB and the offshore contracts, and then the new contracts which you're launching. So there is people who trade our markets who do iron ore, steel, scrap, coal, freight, who do these things every day. So we have arbitrage traders trading between RMB and dollars. So we need to get these guys looking at your market. Next. Next one. So obviously it's a global market, huge potential, and obviously many companies use these indexes and have actually traded these instruments before now. So it's not a big education for us. Okay. So we've already got an active futures market in China. Next. So obviously we're working to bring you forward price curves on our app. So we're going to give you, you know, up-to-date prices of where markets are trading. And then obviously, as I said earlier, you've got these new contracts being launched, which would help market participants, hedge funds, traders, financial companies, and other end users. So we're trying to not just appeal to the producers of pulp and the buyers of pulp, but everybody in this sort of chain, even the banks who lend money to the pulp mill, who are trying to see what the potential pulp price will be in a couple of years' time. Next. So one of our last slides is, can you guys, you know, ignore these products, these futures markets, these instruments? You know, can you just sit back and wait for things which are spot? I think you can't, and I'm very optimistic. I've been going through the 3 V's of why this market should grow. So we will provide forward price curves. Even if you don't use these markets, it's really useful to see what's happening in 21, 22, 23. So when you sit down with a producer or a buyer and you know where the paper market is, you've got to be on the same playing field as them. So you've got to know where the market is. So we're working, obviously, FIS with NOREXECO and obviously Fastmarkets to help build the market. We will do education and seminars. And obviously, the interesting bit is it's all cleared. So it reduces counterparty risk. So it might be that I'm a big trader, but I want to trade with a Chinese customer, but I don't know who that is. But what you can do that now through an exchange. You may get the price wrong, but you'll always get paid. This is why cleared products are working, and most of the things we do today are all cleared. And then obviously Chinese counterparties and the arbitrage is there. Next. So very quickly, why choose FIS? We're not a trader. We're not a customer. We don't have any conflict of interest. We'll try and get you the best price, and we obviously have analysis and market research. We do reports as well, which you can have, and we'll try and help you guys build the market going forward. Next. These are just the contracts for the presentation, if you want this, with all the specs, which are also important, you know, for all the current traders and the new ones. So you click them all through. Next one. Next. And then lastly, I haven't got Quentin Tarantino saying you're going to start to trade, but we hope we're all going to grow this market and develop it further. So please, you know, get on board and start trading. Before I finish, it's also interesting, you know, when you look at that recycled paper you talked about, Sharon, you know, obviously we do containers, and the container rates have gone up like from $1,000 to $5,000. So one of the things we also want to do is package up stuff. So we want to cross-sell some of the products we do. So if you're a paper selling stuff from Los Angeles to China in waste paper, you know, you can maybe hedge that risk of the freight on the container, which has also gone up about 4 times, you know, in the last sort of 6 months. So I hope you've enjoyed my presentation, and I'm looking forward to working and meeting you all when we can. Thank you.
Thank you, John, for a very interesting presentation. It's always interesting having someone to see it from the outside and in. And I think we have some questions for you. How much pulp is shipped in containers and bulk, and how the difference perhaps impact on market prices?
Very good question. So obviously I'm doing my research at the moment. So we said that the global seaborne trade is 55 million tons. I don't know the split between handy sizes and containers, but obviously we've developed a new handy size index. It's a 38,000 deadweight time charter average with the Baltic. So people are using that to hedge. And obviously on containers, we've been working with an Israeli company to create an index for the Baltic. So we have 10 container routes around the world, the main container routes. And in terms of the split, I don't know what the split is. I would guess it's mostly containers on pulp, but I can check that for you. I can have a guess what it is, but it's just another. And in terms of the end price of freight versus pulp, it's probably not huge like your pulp to tissues, because you know, your commodity is very expensive pulp, right? It's $800-900, whereas we're shipping iron ore at $150. We're shipping thermal coal at $50, you know. So freight's a much bigger part of that, but it's still, you know, decent.
Another question: what do you think are the main reason for why it's taken so long to build a futures market on pulp?
It's a good question. Maybe you can answer that.
Well, yeah, maybe we will, but I would be very interested in listening to your answer first.
Maybe because
I can add something. I can add a comment there, because I think when we started off, I don't know, it's been a few years now, and we listed the European contract, and I think they have a huge element of rebate, and that have been causing some noise, and it's causing some reluctance using it for hedging purposes. We're now talking about a 30% rebate, and you're trading it gross. So I think it's easier to get a liquid future market when you have a net price, and when you now have one in China and you have net products, I think that will attract more players, and especially not industrial players, because if you are a professional investor, a trader, a speculator, you're not very familiar with the industry and the index and the rebate element of it.
All right, so it's a bit complicated. But another reason probably is if you look at some of the markets we've helped develop, there's been a catalyst of an event which has caused people to force them to use these products. So we talked about iron ore was a good example. It forced the people because they didn't want to sell fixed contracts anymore. They wanted to do spot index link. We look at the freight markets, you know, but what we have in these markets, we have sponsors, we have people want it to happen. So we get people to come in and say, I want to move my business from this spot business to a derivatives business or whatever. So we need people, companies to help us grow the market really. So it does take time, you've been doing it for 5 years, so you've done a very good job in education, but we just got to take it to the next level now after what's happened in the volatile markets. A bit of a wake-up call is the word.
I have a question for you, since you are very active in the iron ore market, because when I am talking to industrial players, they are worried about increased volatility. So increased volatility, is that a disadvantage or is it an opportunity? What do you think?
So I think you've got to basically be more on the ball, with prices, because things can change much quicker. If you talk to the big mining companies, I think now they're quite like this volatility, particularly with the prices. And sometimes they can hedge forward their positions, and sometimes the paper market over accelerates. So to give you an example, in shipping, the cost of renting a ship on a Capesize went from sort of $7,000 to sort of $25,000. But the paper market went to $30,000 or $32,000. So sometimes it overreacts. So as you said, the volatility can work in your favor, particularly if you get companies who want to close out positions who have a different view. So for example, if you've got a stock analyst looking to buy these shares and buy pulp, he might have a different reason from the physical market. So I'm just saying, and you need to set up desks where you need to follow this on a daily basis. So one of the things these markets, as they develop, you need to have specific people working alongside your physical guys, to be able to take advantage of the information in the physical with where the paper market is trading high or low.
Thank you very much, John. I think we should pass one question that I kind of missed out here. It's for Sharon. Are you with us, Sharon? Can you unmute and take this question?
Yep, I'm here.
Transactions on SHIFI have dramatically increased since 1 year. Would you have a split between the different players acting? Pulp producers, pulp buyers, traders, financial institutions, banks, speculators, and so on. Any change in the split noticed since first year?
I don't have exact information. I hear more this year about physical market players getting involved than I did last year, where people seem to be talking mainly about retail investors. You can look on the SHIFI they do list the most active players, but they tend to be brokers, so you don't always know whose position it is behind that. I think the main difference that we've seen since last year was SHIFI winding things up. So there were a limited number of warehouses that were recognized up till about September, I think. And then since then, SHIFI opened things up so that a much larger range of warehouses could be used. And that sort of triggered an increase in trade.
I can add on to that question. I think the split now, and it's changed a bit, as Sharon says, is more professional investors. I think from the trading volume, it's 40% professional investor and 60% speculators. So with professional investors, it's typical the arbitrage people, it's the hedgers. But if you look at the open interest, the money flowing in and out of the flowing into the market, you have a 60% professional investor and 40% speculators. I think that's the last number I have.
Okay, I think there is a question here more for us. Have you looked into listing paper contracts in addition to pulp? I have plenty of clients looking to hedge testliner too. That is the question. And the answer is that, we just recently listed a recycled paper contract. It's OCC-A 104. when it goes for testliner, we have looked at it. I would say if the industry would like us to list it, we will list it. So it's all about having the market interest. So please come on to us if you have this interest, and we will look more thoroughly into it. Okay, I think we'll go to the next presenter then. Thank you again, John, for a very good presentation. We're kind of changing the scene a little now, and now it's Sjur, and he will look into measuring the levels of risk and what you can actually do about it. Really looking forward to it. It's all yours, please.
Thank you very much. Thanks to NOREXECO for inviting me to this presentation, and also thank you, John and Sharon, for the insights to the pulp market. The title of, and hello to all the audience. The title for my presentation is Quantifying Raw Material Price Risk Given Different Scenarios and Hedging Strategies. Next, please. So I've been working with energy companies on enterprise risk management. And also I know about similar application for shipping, metal companies, and fish farming companies. I'm not an expert at all in pulp markets, but I'm quite interested to know more about these markets. And so the presentation here will be a corporate risk management presentation from the corporate side, how to hedge the risk of pulp prices. By the way, I'm also one of the editors in Journal of Commodity Markets. So if you have any research paper going in the direction of pulp and paper markets, I'd be very interested to receive a paper from you. So next, please. So enterprise risk management or corporate risk management is a framework for corporation to manage all the risks and opportunities in order to meet their goals. So typical risk will be hazard risk, operational risk, strategic risk, or financial risk. So with financial risk, we have commodity price risk, stock market risk, interest rate risk, currency risk, and liquidity risk. So what I'll focus on here in particular is the pulp price risk in context of a paper mill. So my case will be a paper mill, and how that paper mill will need to hedge the pulp price risk. Next, please. So what is risk in this context? So the risk in this context is potential for negative deviation from expected cash flows. So the value of a firm is the discounted expected cash flow in the future years. And so the question is, what do influence these cash flows? Well, for a paper mill, you have the production of paper that is uncertain. You have the paper prices. On the consumption side, you have the pulp consumption, which is uncertain, as well as pulp prices. You also have currency rates, interest rate risk, power prices. In addition, you have taxes, political risk, regulation, reputation, weather risk, biological risk. You have structural changes in the industry. You have a customer's credit and liquidity situation, and also supplier credit and liquidity situation. So somehow you have to manage all these various risks. Focus here again will be just to look into pulp prices and how we can hedge some of that risk. Next, please. So building a corporate risk management model or an enterprise risk management model involves some steps. And as I said, I've done this for energy companies in Norway and around Europe, but I haven't worked yet with pulp in the pulp and paper industry. But I'm more be happy to give you guidance there if you're interested. So we in building an enterprise risk management model, we need to build a model around something that top management and the board of directors know. So future forecast of cash flow, income, balance, key ratio, and credit rating will be certainly of interest. And building such a model having 3 steps. So in step 1, we need to identify all market variables and how they influence the cash flow of the firm. Hence, future income, balance, key ratio, and credit rating. That's the first step. And the second step is to establish forecasting model for all variables. That is, for instance, for pulp prices, we need to have a model of the dynamics of pulp prices and the correlation between pulp prices and other risk factors, for instance, foreign exchange rates and so on. And the final step will be to analyze future possible outcomes by management decisions. So for instance, a hedging of pulp prices will be a decision. And how do various types of hedging influence the variables of interest, like, let's say, the cash flow? That's of interest. And also other decisions like investment decisions and production decisions can be analyzed within a framework like this. Next, please. So the case here will be very simple. It will be a stylized example. This is a company, a paper mill company that sells paper, that is long paper, or buys pulp. It's short pulp. So the production will assume be known here, 20,000 tons per month. And the paper price will also be known, $1,500 per ton. We will, for simplicity, assume no other revenue sources. The pulp production will also be known here. That's also a simplification, 20,000 tons per month. The pulp price, however, will be uncertain. That is measured in dollar per ton. Other fixed costs are assumed to be $5 million. We will only look at hedging versus no hedging of the pulp price risk. And we will start the hedging now in April 2021. We will hedge the first 6 months, 50% of the consumption will be hedged. There is, of course, there are, of course, questions regarding how much to hedge, when to hedge, and so on. I'm coming back to that question later on. But for the time being, we hedge the first 6 months, 50% of the consumption. And according to John's and Sharon's presentation, I've assumed the pulp price volatility around 20%. And we also have a simulation model. And the simulation model is such that the expected prices for the coming months are in accordance to the forward price that we can observe in the market. Next slide, please. So here is some history of the pulp price. We already seen that, and we just observed that it's volatile, and it has increased quite substantially in the last months. Next, please. Here is also the forward price, for the last forward price that was some days ago, and the forward curve that we did observe 1 month ago. And as you can see, the forward price is going upward and then going again downward after a period of time. The forward curve is contain both the expectation of supply and demand in the future, but also includes risk aversion among consumers and producers and other market participants. Next, please. So here is the simulation model. So what we do, we have a stochastic model for the pulp price, and we do simulation for the future months. And the forecast line here is the average or the expected price in the future month, and this fan represents the uncertainty. So at the very end there, in March 2022, prices can be anywhere from 800 to 1,500 within 95% probability. So this is a probability fan. And by the way, this is also my research to make such fans or make density forecasts and risk forecasts. And here it's illustrated with a fan that I think is very nicely done. The company that I work with here is called Simulation Finance. I have no business interest in this company, but the manager of that company allowed me to use the software for this presentation. Next, please. So here is the paper mill, the gross revenue without purchase of pulp. So each month we sell 20,000 tons of paper at a fixed price. And there is also a fixed cost of $5 million. Yeah, and the next slide, please. The gross cost without fixed cost when buying all pulp forward is like this. 20,000 tons are bought every month. And the price here is the forward price. So today it's possible to just buy everything forward at a fixed price, or it's possible to buy everything in the spot market. Then these prices will fluctuate according to that fan I just showed you. Or we can have combinations like the example I'm going to give, where 50% of the consumption is hedged and 50% is left unhedged for the coming 6 months. We can also here include price discounts on pulp in this model, but I haven't done it here. Next slide, please. So to quantify price risk, as I mentioned, I've chosen to use the paper commodity model from Simulation Finance. The model allows to include uncertainty assumptions such as expected price volatility, and the results are presented in probability fans, as we just saw. That shows a range of possible price outcome and the possible effects of hedging that we are now going to look into. Next slide, please. So the first thing we can look at is cost. So here I have the historical cost up to now, March 21, and then future estimated cost according to the model assumption. So here's a cost without hedging, can be between the upper and lower curve here. And with hedging, we have this blue fan here. At the beginning, we see that when hedging, we reduce the possible outcome of the cost quite substantially. We haven't hedged after 6 months, as you see. We could have done that as well. So here we can directly look at the consequences of hedging on costs. Next slide, please. In a similar way, we can investigate the effect on EBITDA when we hedge versus when we do not hedge. So if we do not hedge, we have outcomes according to the upper and lower line here. By hedging, we narrow that fan, as you see here, for the first 6 months. And one way of looking upon this is that we reduce the likelihood of negative scenarios in the first 6 months by this specific hedging. So without hedging, there are possibilities that you might end up with negative EBITDA values in the first 6 months. With hedging, 50% the next 6 months, that is reduced quite substantially. And of course, you also give away some of the upside by doing this. But if, let's say, your target is to have very little, let's say your target is to avoid negative EBITDA in the coming 6 months, one way to solve that will be to have a 50% hedge for the coming periods. Next slide, please. So in general, hedging financial risk for a paper mill involves buying future to reduce price risk according to projected consumption and how much of this to hedge. In a similar way, if you're a pulp producer, you will be selling futures. Hedging is all about seeking to increase predictability, that is to reduce uncertainty in future cash flows by giving away some of the upside. That is illustrated by these probability fans. Hedging allows for better focus on production and consumption planning and investment decisions with minimum exposure to unwanted business risk. And reduction of borrowing costs also to better credit rating. So by hedging, you reduce borrowing costs, the possible outcome of borrowing costs, and therefore also credit rating, and hence increase debt capacity and have more. Will then have more options to take on future investment opportunities. You can also allow for strategic hedging decisions. That is when to hedge, how much to hedge, how far into the future to hedge. And a paper mill can use this strategic hedging because it can use strategic storage. It might have better estimates of future demand and supply, and also better estimates of future prices. Next slide, please. So timing of hedging and decision on how much to hedge, these are important decisions. We can hedge more into the close future when consumption volumes are known, versus less in the distant future when consumption volumes is more uncertain. Strategic hedging also allows for hedging more when prices are low and the forward curve is going downward, versus less when prices are high and the forward curve is going upward. And vice versa for pulp producers. I'm now focusing on a paper mill where you buy pulp. Next slide, please. So I've been using here something called the commodity exposure model, where we can analyze and visualize price and volume risk. So we can look at more risk factors than the pulp price. We can also include uncertainty in the consumption. We can also, at the revenue side, include uncertainty in both paper prices and paper production. We can analyze possible effects of hedging or using various types of derivatives, and investigate risk measures such as valid risk and others. Next slide, please. So this commodity exposure model, you can have a look at it at the reports here at this web link. And there is no registration required. And according to the manager of the company, you can have a free trial version, where you can also perform a complete analysis. You can extend the analysis from this, including more uncertain risk factors, and so on. Please, next slide, please. We have also something called the corporate model, which is a complete financial planning and risk management model. So here we can do financial projections of income statement, balance sheet, and cash flow, and various ratios, key ratios. We can look at consolidated numbers or from parent companies and daughter companies. We can investigate debt management, debt need, debt capacity, measure probability of breaching covenants. Can investigate credit rating and credit spreads and interest rate cost. And by the way, credit rating is quite important these days. So the bank will very often require this type of analysis, at least for the energy companies I've been working with. And according to how they hedge their risk, they will get a better credit rating. And the differences in the credit rating and debt costs can be quite substantial. We can also perform valuation analysis and merger and acquisition analysis here. Valuation analysis and impairment testing can be done. Also, various forms of mergers and acquisition analysis. We can look at various types of financial risk management issues, like currency exposure, interest rate exposure, commodity exposure. We can decompose each risk and see which contributes most. We can see how derivatives can change the exposure. I just shown you one illustration. And we can find and communicate to the management efficient hedging strategies. And we can look at valid risk and other risk measures. These measures are well known among bank and financial institutions, but more and more industrial companies also seem to use those measures in the risk management applications. Next slide, please. Yes, I think that was it from me. And if you have any questions, you can ask them now, or you can contact me later on this email address. So thank you very much for your attention.
Thank you very much, Sjur. I'm sure there are some questions. I would just emphasize that you got a very nice offer here, and that is that after the sequence today, you can actually log in and use this simulation finance model as a free trial user. And it's a really great model, and it's good for doing some simulations on how to handle your risk exposure. So please do that. That's a good offer. Okay. There are some questions. Okay, I'll try with this one. Should we expect more or less volatility as more people use the futures market?
Well, that's an interesting question. I think John and Sharon will be better suited for answering that question. I think it's a hard question.
Maybe John can be. Maybe John can, as he's been in the iron ore market and been with that going from low liquidity to high liquidity, how that have affected the volatility in the iron ore market. It's for sure more visible volatility, but if it's been there before, you have transparency. John B, are you here?
Yeah, I think the more different people involved in your markets will definitely increase volatility. As I said earlier, some people have different reasons to, you've got your physical users, you've got your financial players, you've got the Chinese speculators. So it will probably increase the volatility, yes. Which is not a bad thing. I know it can be a bit of a headache, but you just have to have your risk management tools to manage it.
There is a question to Sjur. Why did you use 20% annual price volatility? Historical annual volatility of pulp price should be significantly lower.
Okay, yeah. So the short answer is that John and Sharon used the number, but I did an analysis myself actually. When you, it's a very good question. So there is of course no absolute answers to this, but if you look at the volatility in the last period, it has picked up substantially, as Sharon and John mentioned, and by using a rolling volatility model, you'll get to that number. But of course, if you look at a longer period, if you use a different model to estimate volatility, that number might be lower. But in this model, in this corporate model I showed you, you can change that assumption. And of course, that will also influence your hedging decision. But I think 20% is I agree on that number. If I use exponential weighted moving average volatility, that picks up the latest changes in the market and put more weight on these versus what happened in the market a long time ago, then I'll reach roughly the same number. But I don't know if Sharon or John will elaborate on that. But I think 20% is a fair number, and in the previous periods it was lower. Yes.
Okay. Any comments from Sharon or John? Okay, another question then. Would it be possible to hedge the difference between uncoated paper and pulp? Who would like to answer that one?
I hope somebody else can answer it, but what it's a good question. So we have similarities in energy where you buy you buy raw oil and sell heating oil. So you have this exposure to the crack spread, the difference between heating oil and raw oil, crude oil. And similar in the fish farming industry, you buy soybean meal and you produce salmon. So you have the exact same problem there. And here the question is to hedge the difference between paper and pulp. So then my question to you: are the future contracts on paper, on papers that a paper mill would sell? I really don't know.
I think there is a challenge on this one right now because there is no contract on the uncoated paper. So there might be a challenge doing that, but if it was, it would be possible. Okay.
There is another one coming in. In commodity hedging, how would you determine the optimal hedging period? In currency risk, usually hedge up to 12 months.
Yeah, the optimal hedging period is not that's not a given answer either. So it depends on how the management view their the risk versus the potential upside. And as I mentioned, the longer into the future your consumption might be more uncertain. Hence, it can be shown that you then hedge less than in the very close future. So the general answer is that it can be shown that it's more optimal to hedge much in the coming months and then less in the future months, because you simply don't know exactly how much you're going to consume. But it depends also on the risk preferences by the management, how much they're willing to hedge. So there's not a clear answer to that. And then if currency risk, corporates usually hedge. It depends. The currency hedges the energy companies I work with does. They hedge. Yes, they hedge usually up to 1 year, but they hedge more in the coming months than they will do in the end of the year.
Okay, there is a COVID-19 question as well. How accurate is your models referring in such a situation like the COVID situation? How can you predict volatility in such circumstances?
That's a good question. So in many commodity markets, the volatility has picked up quite substantially due to the COVID-19 situation. So one way, you need a model that quickly updates the volatility in accordance to what happens in the market. And one such model would be an exponential weighted moving average model of volatility, or some other statistical model for volatility, where you put more emphasis on the recent happenings in the market versus what happened, let's say 3 months ago, 6 months ago, and so on. And then you can also project for the future, but that's more unclear how this COVID-19 will influence the volatility in the coming year. I guess Sharon and John will have more information about that, answering that question.
John, please.
Yeah, so just to answer a few questions there. So when you asked about when is the optimum time to trade or hedge, it depends, as you said, on what the company's view is. But to give you an example, most of the commodities we trade, so for example, freight, 80% of the market is probably the next 12 months, and it's the same with iron ore. The beauty of some of these markets, you can trade out to 21, 22, 23, 24, 25, but there doesn't tend to be a lot of people trading that far out, the lack of liquidity. So it's really sort of 12 months forward is where the main liquidity is. The interesting thing is we're trying to get people to trade further out, because sometimes the differences are quite big compared to the physical market. So for example, if you're a fund and you're lending money to a ship owner to buy a ship, why don't you buy a paper contract in 2024-25? Because it's probably cheaper in fees than lending a ship owner, and less risk, as you've talked about all these risks. So it's really the next 12 months is really where most of the liquidity is. And the second point, obviously, to go back to the question on freight, I will do some analysis for your listeners of the impact of freight rates and the cost of containers. Now, one of the questions I want to ask you guys is, for a 40-foot container, how many tons of pulp are you able to put in one 40-foot container? Because that'll give me a good idea what it is. So if you tell it's $5,000 from Brazil to China and you're putting in 25 tons, it's $200 a ton. So it's 20% of the price. So it's quite high. recycled paper, obviously, is 168 euros. So you can work it out. You know, I can give you the rates. So I'll do a little paper for you, but you need to tell me how many tons of pulp you can put in and how many tons of recycled paper you can put in a 40-foot container. I don't know.
That's great, because now we gave some work to our listeners as well.
That's really good.
I have one question from me again, because when we talk to the producer, they very often say that we are a production company, or investors or shareholders expect us to be exposed to the pulp price. But still, if you look at iron ore, if you look at metals, you see that the large producer are involved in the future market. So how, if you look at maybe you, John B., if you look at iron ore, how did the large producer use the future market? Is it for hedging, or is it for different purposes? And maybe you sure could elaborate a bit as well.
Yeah. So I just want to say it's not easy, you know, Anita, you know, particularly the producers, because the producers are quite traditional, and they will say, well, what happens when the market goes up and I've hedged and I've lost money? But actually, what you should do is you should just show them a picture of iron ore and the stock price of Rio Tinto, and it's a very good correlation. So it works the other way. If the price goes down, your stock price goes down. So in terms of what these guys do, it's taken a bit like your market, probably 5-10 years to get them involved in it, because there was a lot of resistance, because they said, we want to make money on producing better quality iron ore. We don't really want to do these derivatives. And we're too big, because we can basically, you know, manipulate the market or try and distort the market. So it's taken a number of years, but what they do now is purely 3 to 6 months forward. They tend to do a lot more hedging against their price, because they're selling index-linked contracts to China. So every month, the Platts average price is 150, might be next month 160, but they have no idea what that price is, right? So the only way to hedge that index-linked is to fix a floating price. So that's what they do. And obviously, some of them now are trading options. So quite a lot of these producers like options as well, because it's that's another thing we can have another seminar on. Options on iron ore is also a big market.
But do you see any of them using the future as hedging storage or financing storage, or is that not that common? I know that's very common in copper and alloy, but I don't know if that's common in iron ore.
I think so.
No.
No.
John, there is an answer to your question. 26 tons on a 40-foot container.
So you rock and roll. So I wasn't far off, 25. So it's roughly 20%. You know, so it's quite high then. So what we're trying to say is you can cross. You can do all the elements of the contract. You can do the freight and the container as well, right? Yeah, to hedge.
Okay, I think we are coming to an end, and I would use the occasion to thank the panelists for sharing their competence with us. I will also thank the attendees for taking the time to listen to us. And as always, please contact us if there are any questions at all, or go into the NOREXECO.com page, and we will assist you in any way possible. Please answer the questionnaire that you will receive after the webinar. We would really appreciate if you do that. And again, log in on the Simulation Finance. We will give you the login details so you can simulate your business exposure. So thank you again, and have a nice Easter holiday when it comes.